You might not believe this, but one of the biggest bank meltdowns of the 1980s started in the back of a shopping mall. Penn Square was founded in 1960 in Oklahoma City. It started as a modest storefront community bank that pursued a conservative investment strategy. Then, in 1977, Penn Square hired a new CEO, Bill Patterson. This marked a turning point for the bank. Bill decided the bank needed to pursue growth at all costs. You see, his compensation was linked to the bank's growth, which gave him a perverse incentive to pursue risky lending. And who wanted these loans? Well, oil prices were sky high, and thus Penn Square started making loans to the energy sector. Bill began reducing the bank's holdings of conservative securities to free up more capital for lending in the oil and gas industry until almost their whole portfolio was nothing but oil and gas. Penn Square's mantra in the early 80s was oil prices will never go down. They loaned money to almost anyone with an oil rig. And it worked, at least at first. Assets grew from about 60 million to just over 500 million in a few years. In 1982, there was a supply glut of oil, and thus the oil party stopped. Penn Square's heavy concentration in energy loans quickly drained its liquidity as borrowers defaulted en masse. When depositors got a hold of this story, they quickly stormed the bank, waiting in lines to get their deposits back, almost sealing the bank's fate. Regulators swooped in over the 4th of July weekend in 1982 and shut down the bank. But here's the kicker. Penn Square wasn't just risking their own money because they had sold portions of their risky loans to much larger banks that trusted their underwriting process. When Penn Square went down, it didn't go down alone. Because of the interconnectedness of our financial system, Penn Square also helped bring down Continental Illinois and Chicago, which became the biggest bank failure in U.S. history. The saga of Penn Square teaches us about the dangers of overconcentration in a single sector, the systemic risk of an interconnected banking system, and the importance of doing your own due diligence.